You know that feeling when you're sitting in your car, stuck in traffic, and your phone buzzes with a notification from your bank? You glance down, just for a second, and you see that your car payment has been automatically deducted. $472. Gone. Just like that. And you think, okay, that's fine. That's just normal. That's just part of life now. And then the light turns green, and you keep driving, and you don't think about it anymore. That's the thing.
You don't think about it. Nobody really does. It's just baked into the background noise of adult life. Like rent, like groceries, like the Netflix subscription you forgot you still pay for. The car payment is just there. Reliable as a sunrise. Steady as the tide. But here's what's wild. Here's the thing that sort of crept up on me one afternoon, when I was doing nothing more profound than eating cereal and staring at a spreadsheet. That car sitting in your driveway, the one with the fresh smell and the Bluetooth connectivity and the backup camera you honestly love, might be the single most financially destructive decision you ever made. And the terrifying part? It wasn't dramatic. There was no villain. Nobody tricked you in a back room. You signed the papers with a smile, shook someone's hand, and drove home feeling like you'd done something right. My name is Sam, and I spend probably too much of my time thinking about money. Not in a Wall Street suit and briefcase way, but in a genuinely obsessive, why do smart people keep making the same financial mistakes kind of way. I find myself fascinated by the gap between what people know about money and what they actually do with it, because those two things are often wildly different. And the car payment? It is, without question, one of the most fascinating and quietly devastating examples of that gap I've ever come across. By the time we're done here, I want you to understand something that goes a lot deeper than cars are expensive. I want you to see the architecture of the trap, how it's built, why it feels so normal, and what it's actually costing you in ways that most people never stop to calculate. Some of this might feel uncomfortable. Some of it might make you look at your driveway a little differently, but I genuinely think, it could change the way you make financial decisions for the rest of your life. So let's get into it. The monthly payment illusion. Let's start with the thing that makes this whole trap work. The single most powerful piece of financial sleight of hand that the car industry, and honestly most of consumer lending, has ever pulled off. It's called the monthly payment illusion, and it goes something like this. You walk into a dealership. You're not thinking about the price of the car. Nobody really is. Not in a real, visceral way. You're thinking about whether you can afford the payment. And the salesperson, who by the way is very good at their job, knows this. They're not selling you a $40,000 vehicle. They're selling you a $549 a month lifestyle upgrade. Those are two completely different psychological experiences. Think about it. If someone said to you, "Hey, give me $40,000, you would feel that. You would feel the weight of it. Your brain would start doing math, pulling up comparisons, thinking about what else $40,000 could do. But $549 a month? That's just a thing you pay. It slots right in next to your rent and your phone bill and disappears into the general blur of monthly obligations. This is not accidental. The shift from total price to monthly payment is one of the most deliberate and effective anchoring techniques in all of retail. When you focus on the monthly number, you lose your grasp on the full cost. You stop asking, "Is this worth $40,000?" and start asking, "Can I make this work in my budget?" Those are fundamentally different questions, and only one of them serves your long-term financial health. Here's the practical breakdown. Say you finance a $38,000 car over 72 months, which is 6 years by the way, and 6-year car loans have become genuinely alarmingly common, at an interest rate of around 7%. Your monthly payment lands at something like $580. That feels manageable, right? Maybe even reasonable. But over the life of that loan, you pay roughly $41,700. You paid more than the sticker price. And that's before insurance, before registration, before maintenance, before the inevitable moment 3 years in, when something expensive breaks. The car cost you $41,700, but it never felt like it, because you only ever saw it $580 at a time. Depreciation, the silent partner nobody introduces you to.
Okay, so now let's talk about the thing that makes the monthly payment illusion even more devastating, and that's depreciation. And I know, depreciation sounds like a boring accounting word. Bear with me. This is where it gets genuinely painful. The moment you drive a new car off the lot, it loses somewhere between 9% and 11% of its value. Not over a year, not over 6 months, immediately, before you've even merged onto the highway. By the end of the first year, most new cars have lost somewhere between 20% and 30% of their purchase price. So you buy a $38,000 car. A year later, it's worth maybe $27,000. You still owe, let's say, $33,000 on the loan, because in the early months of a loan, most of your payment is going toward interest, not principal. So you are now, officially, mathematically, $6,000 underwater. You owe more than the car is worth. This is called being upside down on your loan. And somewhere between a third and a quarter of all car owners with loans are in exactly this position right now. And here's the thing that gets me. When you're upside down on a car loan, you're kind of stuck. You can't sell the car without paying the difference out of pocket. If your car gets totaled, your insurance pays what the car is worth, not what you owe. And unless you have gap insurance, you're writing a check to cover the difference, even though you no longer have a car. You're paying for something that's gone. There's a metaphor I keep coming back to. Imagine you're filling a bathtub, but there's a drain at the bottom that's open. Every dollar you pour in, some percentage just flows right out. That's depreciation. You can keep filling, you can make every payment on time, keep the car spotless, never miss a service appointment, and the drain is just open. Always. You don't close it, you just keep pouring. The upgrade cycle and why it's designed that way. Here's where I want to zoom out a little, because the individual car payment is one thing, but the pattern of car payments, the way most people experience them over a lifetime, is something else entirely. And I think this is the part of the conversation that almost nobody has. The average new car loan in the United States right now is somewhere around 68 to 72 months. Almost 6 years. But the average person trades in or replaces their car every 3 to 4 years. Do you see the problem? You're taking out a 6-year loan, but you're only keeping the car for 4 years. So when you go to get your next car, you still have 2 years of payments left. What happens to that remaining balance? It gets rolled into the new loan. The dealer calls this trading in, and it sounds clean and simple. But what you're actually doing is carrying your old debt forward into a new, larger debt and spreading it out over another 6 years. This is the cycle. This is the trap within the trap. It's not just that any single car payment is expensive, it's that most people never, ever stop paying for cars. The loan ends and immediately, sometimes before it even ends, a new one begins. From the age of 22 to the age of 65, that's potentially 4 decades of continuous car payments, every month, without stop. Let me give you a number that sort of stopped me in my tracks when I first did this math. If you carry a $500 monthly car payment for 40 years and never invest that money, you've spent $240,000 on car payments alone. But if you invested that $500 every month for 40 years at an average market return of 7%, you'd have somewhere around $1.3 million. $1.3 million. Gone. Not because you made one bad decision, but because you made the same moderately bad decision automatically every month for 4 decades without ever really stopping to question it. That number isn't meant to make you feel bad. It's meant to show you the real cost of something that doesn't feel costly because it's just normal. But I need a reliable car argument. Okay. I have to address this because it's the thing I hear every single time this topic comes up. And honestly, I get it. I understand the impulse. People say, I can't drive a beater. I need something reliable for work. I have kids. I need to be safe. And look, these are real concerns. I'm not going to sit here and tell you to drive a rusted-out 1994 Honda Civic with 280,000 miles on it if that genuinely doesn't work for your life. But I want to gently push back on the assumption buried inside this argument, which is that reliable equals new or financed. Because here's the data on that. Cars built in the last 15 years are, generally speaking, extraordinarily reliable. Modern manufacturing has gotten so good that a well-maintained 5-year-old Toyota Camry or Honda Accord with 60,000 miles on it is genuinely unlikely to leave you stranded. These aren't the cars your grandparents drove that rusted through after 5 winters. Automotive engineering has come a long way. There's a sweet spot that a lot of financially savvy car buyers have figured out, and that's the 2 to 4-year-old used car, bought outright or with a short loan, with a solid maintenance history. At that point, the original owner has absorbed the brutal first-year depreciation cliff. The car is still relatively new and under many manufacturer warranties. You get the reliability without the premium price of brand new. A $22,000 car that you own outright is infinitely more financially healthy than a $42,000 car you're financing for 6 years, even if the $42,000 car has heated seats and a fancier screen. Because the car you own outright, nobody can take it from you. Your monthly obligation is 0. And that 0 is one of the most powerful numbers in personal finance. What the dealership actually makes money on. Let me pull back the curtain a little bit on the business model, because I think understanding why the system is set up this way makes you a much better consumer. Most people think dealerships make their money on selling cars, and they do, a little. But the real margin, the place where dealerships actually build significant profit, is in the financing, the extended warranties, the add-ons and packages that get quietly rolled into your loan during that last signing phase when you've already been there for 4 hours and you'd agree to almost anything to leave. When a dealership facilitates your financing, they often receive a dealer reserve, essentially a kickback from the lender for any interest rate they can get you to accept above the minimum. If a lender says, "We'll finance this person at 5%, and the dealer presents you with 7.5%, the dealership keeps that spread. They have, in that moment, a direct financial incentive to get you to accept a higher interest rate. And they're very good at making that conversation feel routine. The average amount a dealer makes on the back end, financing, warranties, insurance products, can sometimes exceed what they make on the car itself. You're not just buying a vehicle, you're walking into a very sophisticated financial products store that also happens to sell vehicles. And none of this is secret, none of it is illegal, it's just the system, the playbook. And if you walk in not knowing it, you are playing a game where the other team has spent decades studying the rules and you just showed up. Insurance, maintenance, and the true cost of ownership. Let's talk about a concept called total cost of ownership, because the monthly payment is only one part of what a car actually costs you. Here's what typically comes with a new or newer financed car. Your insurance premiums go up significantly because lenders require comprehensive and collision coverage as long as there's a loan outstanding. Depending on where you live, your age, and your record, this can add $100 to $200 a month or more compared to the coverage you'd carry on an owned older car. Registration fees on a new vehicle are substantially higher in most states because they're often calculated as a percentage of the vehicle's value. Maintenance on a new car sounds cheaper because warranty covers defects, but the cost of manufacturer-required service intervals, oil changes at the dealership, tire rotations, the 5-year maintenance package they sold you at signing, adds up quietly over time. And then there's the psychological cost, which doesn't show up in any spreadsheet, but is very real. When you're making a $550 car payment, you feel the obligation. It's a fixed wall in your budget. It limits your flexibility in ways you don't even fully notice until something else in your life goes sideways. A medical bill, a job change, a move. And suddenly you're looking at your budget and realizing there's almost no room. The car payment doesn't care about your circumstances. It comes out every month regardless. Financial flexibility. The ability to absorb a shock, to take a risk, to say yes to an opportunity, is worth something. It's worth a lot. And every large fixed obligation in your life slightly reduces that flexibility. That's not necessarily wrong, but it's a trade-off you should be making consciously, with full information, rather than automatically. The psychological hooks. Status, identity, and the story we tell ourselves. Okay, I want to go a little deeper here because I think the financial math, as alarming as it is, isn't actually the core of why the car payment trap is so hard to escape. The core is psychological. It's about identity. And this is the part of the conversation that I find genuinely fascinating. Cars are, in American culture especially, deeply tied to how we see ourselves. What you drive communicates something about who you are, your success, your taste, your priorities. We absorb this from everywhere. Movies where the hero drives something sleek and powerful, ads that don't sell you a car so much as sell you a version of yourself. The subtle social arithmetic of arriving somewhere and people seeing what you pull up in. I'm not going to pretend this doesn't matter, or that it's shallow to care about it. Humans are social creatures. Status signaling is baked into our neurology. We can't fully escape it, and it would be exhausting to try. But here's the question worth sitting with. How much are you paying, per month, for the story your car tells about you? Because if you're driving a $45,000 SUV on a $65,000 salary, a significant portion of that payment is essentially an identity subscription. You're renting a self-image. And self-images, unlike cars, depreciate instantly, infinitely, the moment you need to project a newer one. There's a phrase I keep coming back to from the world of behavioral economics. We buy things we don't need, with money we don't have, to impress people we don't know. It's a little blunt, maybe a little harsh, but I think when you apply it specifically to cars, it lands uncomfortably close to the truth for a lot of people. The interesting thing is that genuinely wealthy people, I mean people with real, durable, multi-generational wealth, are statistically far more likely to drive modest, paid-off vehicles than the people who look wealthy. This is a well-documented pattern. The flashy car is often not a sign of wealth, it's a sign of spending. Real wealth is quiet. Real wealth is liquid. Real wealth doesn't need to perform. What breaking the cycle actually looks like. So what do you actually do with all of this? Because information without application is just anxiety, and I don't want to leave you feeling worse about your situation without giving you something to work with. First thing, and this is genuinely simple even though it doesn't feel simple, is to stop the rollover. If you're currently in a car loan, the single most powerful thing you can do is commit to keeping that car until the loan is paid off. I know the new model just came out. I know your car is 3 years old and not as exciting as it was. Keep it. Finish the loan. Then keep it for 2 or 3 more years after that, making what used to be your car payment into an investment or a savings contribution instead. This is called the own your car phase of the cycle, and most people never experience it because they trade before they get there. Second thing, if you're in a position to buy a car, either now or in the future, give serious consideration to buying used, paying cash, or with the shortest loan possible, and buying for reliability rather than status. This is easier said than done, I get it. But even just deciding that your next car will be 2 years old instead of brand new, purchased at a lower price point than you'd originally considered, can change your financial trajectory in a meaningful way over time. Third, and this is more subtle, start to question the narrative you've absorbed about what your car says about you. This is deep work. It's not just financial, it's psychological. But I'd argue it's some of the most valuable work you can do. Because as long as your sense of self-worth is tied to your vehicle, the car industry will always have leverage over you. They'll always be able to sell you the next thing. And you'll keep paying for it. The bigger picture. Here's the thing I want to leave you with, and I want to say it plainly because I think it matters. The car payment trap isn't just about cars. It's a window into a larger pattern. The way modern consumer culture has engineered a system where the financially destructive choice is also the psychologically comfortable, socially normalized, easy choice. The dealership isn't evil. The banks aren't plotting against you in a secret room somewhere. They've simply built a very elegant machine that extracts money from the gap between what you know and what you feel, between your long-term interests and your short-term desire to feel good, feel successful, feel like you're moving forward. And the car is just one example. You'll find the same architecture in timeshares, in furniture financing, in buy now, pay later services, in credit card rewards programs. The machinery is everywhere. Once you see it in cars, you start to see the pattern in a lot of places. And that awareness, that friction between your impulse and your better judgment, is one of the most practically valuable things you can develop. The quiet road. I want to end with something a little more personal, because I think it's easy for this kind of content to feel preachy, like someone standing on a hill telling you you've been doing it wrong, and that's genuinely not the energy I want to leave you with. The truth is, most of us have made this mistake. Most of us have been in the showroom, felt the excitement of the new car smell, and signed something we didn't fully understand in a room that was deliberately designed to make us feel good about it. I've been there. The people I respect most financially have been there. It's not a moral failing. It's a very human response to a very carefully engineered environment. What changes things isn't shame. Shame doesn't build wealth. What changes things is a shift in perspective, a quiet, firm decision to see these systems clearly and start making choices that serve your future self rather than your present comfort. Because here's what's waiting on the other side of all of this. Not deprivation. Not driving embarrassing cars and suffering for some abstract future. What's waiting is margin, financial breathing room, the ability to weather a storm without panic, the freedom to leave a job you hate or take a chance on something you love, the compounding, snowballing sense of control over your own life that comes when you stop leaking money into things that don't serve you. That's not a small thing. That's everything. So the next time your phone buzzes and you see that car payment notification, I hope, just for a moment, you think about this conversation. Not with guilt, just with curiosity. With the quiet, useful question, is this still working for me? Am I in this by choice or just by habit? Because there is a difference, and knowing the difference is where it all starts. If this got you thinking, I'd love to hear what came up for you in the comments. And if you know someone who's about to sign on a new car loan, maybe share this with them first. Not to talk them out of anything, just to make sure they see the whole picture before they decide. Take care of yourselves. I'll see you in the next one.